Hi, how's it going everyone? My name is Henk and welcome back to the channel. Today we'll be taking a look at the tech and software company Plexure Group. So Plexure Group has been considered a growth stock by many investors in New Zealand, and certainly they have had a massive gain in their share price over the past year, from around 40 cents per share during the virus lows to a high of about $1.50 per share in the 6 months directly after. Now since then, they have gone into a significant decline and are currently sitting at about 70 cents per share at the moment. So we'll be taking a look at whether or not this trend is likely to continue and whether or not they are a good company for you to invest in. But before I continue, around 80% watching are still not subscribed to the channel, so be sure to subscribe if you haven't already. It'll show your support and help boost my ego. Without further ado, let's get straight into it. So who exactly is Plexure Group? Plexure Group develops mobile software solutions that help brands with customer engagement and relationship management. Now, it allows brands to send out personalized offers to individuals to increase interaction and brand loyalty. Now, their main clients are quick service restaurants and grocery stores, and they have partnership with big brands such as McDonald's and 7-Eleven. They are a multinational company with operations in Asia, Australasia, North America, Latin America, and Europe, with their headquarters in Auckland, New Zealand. For businesses like this, one of the main things that I wanted to see was that if there was anything that significantly differentiated them from other mobile solutions and software provider that make Plexure stand out from the others. Now, this is what Warren Buffett called the moat of the business. Now, this is an important point because if there is nothing significant that separates Plexure from their competitors, eventually they would have to compete on the lowest factor, which is the price. So once you get into a price bidding war with similar products or service companies, it will eat away at all the profits of the software company. In order to find out whether their app stands out, I looked into a case study of their order and pay app for McDonald's Japan. In the McDonald's Japan app, they provide a mobile platform that allows users to receive personalized offers, order and pay all within the same app, which is great, very good stuff. They also claim that McDonald's Japan is the #1 free app on the App Store, which is certainly not true. I looked it up and it's not even in the top 50 in the all free apps category. But it is one of the top apps in the food category, but certainly not the top one. Overall, it looks like a good app that does its function very well, but there's nothing particularly interesting about it. Now, this was echoed by the 3.5-star rating on the Google App Store. With that in mind, let's look at the financials of Plexure. Over the past few years, Plexure has increased their revenue pretty much every year. They have also had an increase in earnings year after year, but despite all that, they are still not a profitable company. Now, sometimes this is acceptable for a growing business because they are reinvesting their earnings back into expanding the business. Now, for example, they had a net loss in earnings of almost $8 million in the year of 2020, but much of it could be attributed to the increase in salary and contractor costs going from 7.5 mil to 20 million. Now, this was in their annual report. Forecasted earning growth for Plexure is estimated to be around 7.5% compared to 30% for companies in the similar industry. Now, this is quite a bit lower than the industry average, which is not a good sign. Now, the annual revenue growth is expected to be around 16.8%, which is comparable to the industry average of around 17%. This means that Plexure is not expected to be profitable over the next 3 years. So if you are holding onto Plexure shares, you might need to hold on to it for quite a while before the price will bounce back. In terms of charts for Plexure, they're currently still in a downtrend with no real reversal signal. So if we draw trend lines for the price action, the current price still falls within the downtrend. So unless the price starts breaking above the downtrend line, it is likely to keep on going lower for the time being. One common saying when it comes to buying company shares is to try not to catch the falling knife. So you want to wait for a reversal signal before putting in a significant amount of money in. Otherwise, you might just end up watching prices go lower and lower and lower. MarketWatch gave Plexure a target price of $1.58 per share, which I think is highly optimistic and should only be taken with a grain of salt. Overall, I am not hugely in favor of the current digital marketing boom where companies are trying to bombard users with targeted ads. Now, because I am starting to believe that the true effects of digital marketing platforms are actually more limited than you would think. Now, in an episode of the Freakonomics podcast, where they discuss the effectiveness of digital advertising, independent researchers turned off the digital keyword search ads for eBay. And those are the sponsored ads that pop up on top of Google searches. And then they measured the actual sales afterwards. Overall, they found that the impact on average was pretty much zero, or at least extremely negligible. But how could this be? Google and Facebook and all the digital marketers all said that digital ads are the future and how they could target individual customers specifically. Now, how could it possibly be not effective? So one potential reason here is that there are 4 different parties in play here. There's the retail shop that wants to get customers by buying ads, and there's a platform that sells the ads, such as Google, Facebook, or other digital platforms. And then there's the people that make the ads. And finally, there's these analytics companies that want to show how effective these ads are making small retail shop money. Out of the 4, 3 of these parties basically want the retail shop to buy more ads. So there's no incentive for them to say that the ads are actually not as effective as they are supposed to be. Now let's go back to the case for Plexure. There's a few reasons why I'm personally not invested in Plexure. First of all, they are a relatively small cap company at around 125 million. Now, share prices for small cap companies tend to be much more volatile on the market. Secondly, I am not convinced that the mobile customer solutions provided by Plexure Group are able to significantly differentiate themselves enough to carve out a niche in the space of online digital marketing. Now, this doesn't mean that they are a bad company or they don't make good apps. I just think it's a very competitive space that's really hard to stand out. Thirdly, I think the effectiveness of digital targeted ads are overstated, and we're currently in a bit of a bubble here because we're constantly bombarded with so many of these ads. It's becoming easier and easier to tune them out as mere background noise. If you're personally invested in Plexure, I would love to hear your thoughts on that. And check out my other videos for analysis on other New Zealand companies, and I will see you in the next video.